Ladies and gentlemen, good evening and welcome to this fourth episode of the IPO video live stream with me, Patrick L. Young. It's 6 o'clock in London, 1 p.m. in New York, 1 a.m. in Hong Kong, 3 a.m. in Sydney, 10 a.m. in San Francisco. The day is yet young on the West Coast and in Silicon Valley. It's 10:30 at night in Mumbai, getting ready for bed, but here's something to keep you awake. It's the live stream coming to you from Valletta, Malta, and also with our guest in the UK today. IPO Video Live is the new live stream, in Patrick's opinion, where I delve into matters of moment in the financial and business world. We're streaming to the world via LinkedIn and YouTube, possibly even Facebook too, if the gods are propitious. Episode 1 was economics a few weeks back, presented by myself. Episode 2, we went from AI fintech to nickel mining through the cryptocurrency universe with Christopher Messina, the CEO of Crowdfill. And last week, we produced episode number 003. You can see a pattern there. It's a very simple numerical indicator. Episode 3 included the ever-fascinating Peter Randall, who discussed revolutionizing the value chain of market structures. All those episodes can be seen on LinkedIn and YouTube. Well, tonight we're streaming live. Thank you very much, everybody, incidentally, who's been sending comments throughout the course of the last several weeks. Your remarks are welcome. Put them into the stream and we will revert. We'll endeavour to comment. Use your questions that you may have for our excellent guest this evening and otherwise discuss how we can engage with you during the course of this broadcast. Your input is very, very welcome. If you have a question or even a comment, type it into the sidebar or wherever that bar appears on your browser, and we'll get back to you forthwith. Tonight, it's another bumper episode in store with our special guest, Martin Watkins. That's coming up in a minute. First up, as we look to show you a pretty picture this week, a neat graphical representation from the website order.com, which demonstrates the seismic shift in coal usage patterns in Great Britain. Last year, the UK used 8 million tonnes of coal. That's the same level as 1769 AD. Now, if you can't recall 1769 AD, let me refresh your memory by showing you the wondrous invention of the time, the first ever self-propelled automobile. The eponymous Cugnot tractor, designed by Nicolas-Joseph Cugnot of France. It took only 45 minutes from the starting point to heat up the boiler. And then you could move at an incredible 3 miles per hour. Radical stuff for 1769, and indeed radical stuff that Britain can manage to propel their economy using as little coal as 250 years ago, despite the islands housing some 67 million or so people, compared to the 6 million people the last time it used this little coal. At the same time, while folks are musing that this is the point where the record-breaking Nasdaq stock index is either massively overvalued or represents awesome long-term buying power, with stock markets approaching the stratosphere faster than Virgin Galactic spaceships, it's worth noting that the balance sheet carnage amongst some firms in the real world of business is pretty extreme. 3 random examples. Abu Dhabi's Etihad Airways, an excellent airline which we have enjoyed several flights with in the course of the past, and we look forward to flying again. Anyway, Etihad Airways, they lost $758 million in the first half of the year. Elsewhere, Wynn Macau Casinos, thanks to lockdown, they posted a $351.6 million loss, while Volkswagen will need to sell a lot of dodgy diesels to moot back the $3 billion that they lost during the first half of the year. Now, way back in 1999, my original book, Capital Market Revolution, I noted how the old banking halls had often been remodeled into elegant bars and restaurants. One of my favorite in the genre remains 1 Lombard Street, which I mentioned in Capital Market Revolution itself, not long after it had opened as a restaurant following a wondrous banking hall history. Anyway, back in macro real world, what's happening to companies' bottom line stuff over in the City of London at the epicenter of the financial centre, aka at the junction of King Street, the Royal Exchange and 1 Lombard Street? The work from home epidemic related to a certain viral load has left that restaurant with the same name, One Lombard Street, achieving 10% of the turnover that would be usual in August, with a 90% decline not unique amongst city hostelries. And given the results I snapshotted before, which are no means unique, I cannot help but wonder about these results from public and private firms impacting the economy. I mean, a few billion here, several hundred million there. Sooner or later, we're going to be talking about a lot of real money being lost. Meanwhile, of course, a big story was instructive about how, tragically, fertilizer components and poor storage don't mix in the most wretchedly disastrous of fashions. Given how the Beirut blast will fuel a further economic downfall in the Lebanon, Zawa, the Middle Eastern news site, gave the most optimistic headline I could find: how the Beirut blast will fuel a further economic downfall in Lebanon. Some ministers have quit, and ultimately now, of course, in the contemporary tragedy, as John Holzman described it, we've seen the entire government has offered to resign, but they remain in situ pending another smoke-filled room repo amongst the ruling classes, while France's President Macron did the right thing, even if the optics by comparison to, say, the Gilets jaunes is a touch tricky in France, by visiting Beirut and threatening to disintermediate Lebanese authorities from the aid effort. Meanwhile, there's upheaval in Belarus. Alexander Lukashenko seems to have won by a large margin when the votes were counted, but not in a manner that was deemed convincing by many. As Radio Free Europe, Radio Liberty put it, as Belarus's strongman seeks to extend his embattled rule, Moscow watches warily. Upheaval in Belarus may not appear to impact the parish, but it's had various HFT offices there over the years, and the nation has been pushing a tech development strategy, including fintech, for some time. Sitting between Poland and Russia, the Baltic states and Ukraine, like Lebanon, Belarus is potentially a major point of contention for regional powers as well as the USA. And that brings us back to financial market structure, which saw the biggest acquisition by the Intercontinental Exchange. I noted the media stressed in Exchange Invest, of course, this was ICE's biggest deal ever. However, I preferred in Exchange Invest Daily, that's the newsletter of market structure, which I produce every day. I preferred to term this deal ICE's biggest deal yet. For there is no doubt there are more of these to come. Unfortunately, this one got into the public domain, perfectly packaged to, well, unlike the excellent idea of buying the becanned eBay, it was not throttled by the inadequate vision of some ill-informed onlookers. It's a huge boost for the ICE digital mortgage business, something that came as a huge shock to the market, as of course nobody knew the ICE's entrepreneurial leader, Jeff Sprecher, would be looking for such a deal. Oh, apart from this statement, for example, during a 2017 ICE earnings call, which has been repeated often since. It's so obvious to us that the market is going to become more electronified, Sprecher said at the time. Once upon a time, ICE was a strong recommendation, as while the strategy was not obvious, I could see it had momentum and coherent management in execution and vision. Nowadays, ICE actually share their vision with the market quarterly, and still some folks get surprised. If nothing else, that gives a fair bit of perspective on just why there were voices unable to see the value all those months ago before COVID-19 in the missed eBay opportunity. Given deals like Ellie Mae, a cool $11 billion paid in cash and a bit of stock, it's not surprising that Jeff Sprecher ranked #1 in the inaugural list of the Exchange Invest most influential 1,000 people. And indeed, there were 999 others on that list, as you may well be able to calculate, out of 1,000 people, including our guest from last week, Peter Randall, who claimed special honours in the blockchain sublist. However, amongst the people who were stars in this book, the world's most influential people in market infrastructure, one of them is our guest this evening, Martin Watkins, CEO of Coinswood Group, who in many ways sits atop the apex of cryptocurrency and our digital future. However, enough of his humble abode from which he joins us today. He was actually rated the most significant Eminence Grise in the parish of financial market structures. He has high-profile executive management and enjoyed many advisory roles in London, New York, Paris, Brussels, Frankfurt, All the financial centres across the world pretty much have been blessed with Martin's expertise at some time or another. And he's worked right across the epicenters of financial market structure, across that spectrum from front office to back office in many fascinating issues. Most recently, he was the lead for EMEIA in exchanges and financial market structure at Ernst & Young, EY Group. Nowadays, as well as running Kernswood Group, Martin is a non-executive director of that wondrous educational body for the world of finance, banking and markets, the Chartered Institute for Securities and Investment. Don't forget to ask us lots of questions, ladies and gentlemen. Leave your comments in the sidebar, the top bar, wherever that bar is. We look forward to hearing from you. Ask your questions of Martin. Martin, good day to you. How are you today?
Very well, thank you, Patrick. Great to join you this evening. Certainly from my side, based just west of London, it's a particularly warm evening. I've turned the fan off so we don't get too much background noise, but a real pleasure to join you. And if I may, Patrick, just on one small element, I stepped down after serving my full term as a non-exec director of the Chartered Institute for Securities and Investments, and very recently stepped down as chairman of their FinTech committee, but I'm still the founding chairman of European regulations there, a member of the membership committee, and still an advisor to the FinTech committee. So just that little bit, the parish is moving so quickly, just want to keep you up to date on the latest events, and that was just because I'd served my term of years. Good governance.
Excellent altogether. So Martin, actually give us a little bit of background. I hinted at it earlier on. You're sitting on the apex of cryptography. Tell us a little bit about the house you're in today.
Certainly. Thank you, Patrick. Well, I'm very fortunate. I mean, my career is based on three things. One is technology. The second is building and running businesses and helping people to run business. And the third is wholesale finance. And the house that I'm sitting in is the house of one of the Great Britain's two finest cryptographers from World War II, decoding the Enigma machine. It's the house of Dilwyn "Dilly" Knox. Dilwyn Knox is the other half, the alter ego of Alan Turing. And whereas Dilwyn Knox was from the Navy using languages to decode Enigma machines, and as Beta will naturally inform us, the Polish led a lot of the work here. It was Dilwyn Knox who persuaded the Polish to send over the particular Enigma machine that Alan Turing became famous for. Alan Turing from the army was using mathematics to decode, and both were successful because there were so many Enigma machines there. So I come as a technology person from my roots. I'm very blessed to be living in the most wonderful rural Buckinghamshire countryside that I was also born in. I've got cryptography and technology all around me. I've got almost as many screens as trading desks. And the thing that fascinates me is actually with quantum computing coming along, all of the cryptographic disciplines and principles that were first learnt in the late 60s and are continuing very much in our thinking even today are going to be challenged when quantum computing comes in, because those machines potentially are going to have so much power that they will break the cryptographic or the encryption and the hashtag coding that we currently have today. So a fascinating time to actually see both the leveraging and the expansion of technology based on the today, but knowing that the next generation is going to ask us to rethink, remove our veils of how it used to be done, and we're going to have to think yet again of how we can build resilient, stable, and innovative financial markets.
Gosh, innovative, stable, resilient financial markets. And you've been around for 25 years. Whoa, big question. What sort of change have you seen during that time?
Oh, goodness me. Let's start right at the beginning. I was very fortunate. I worked for the Norwegian government on weapons and defence and computer technology, and I was the UK representative leading the R&D team here in the UK. The rocket scientists were based in, metaphorically, rocket scientists were based in Norway. But I moved from there quickly into the city, and it was at that stage that I was working closely with Lloyd's of London. And for this reason, I've looked at Lloyd's of London in a different way to many other people. I've looked at Lloyd's of London and the insurance market, and Lloyd's particularly, as being an exchange with market infrastructure support. It is the place that you'd go for price discovery. It is the place you'd go for settlement finality and the claims handling and processing. And in the mix in the middle, there's a lot of risk management that goes on with the offsetting of reinsurance, excess of loss. There's many different layers that would be put in there. So my career started, as I would mildly say, helping an FMI in the back office claims side of Lloyd's of London with technology based around Norse data machines. And in those days, when something actually went wrong, it was fascinating to see that a machine crashing was because somebody had hard coded that there couldn't be more than a certain number of digits in a transaction. Today, I remember we sort of heard Peter Randall last week talking about there being COBOL machines running on mainframes and so on. Well, I only have to go back as far as 92, 93, 94, and we were still sending punch card trays over to Chatham to be pushed through an IBM mainframe. Things have accelerated a lot from there, but my career started in technology in the city with working with the claims office at Lloyd's of London. I sort of went on from there, joined a Credit Suisse IT subsidiary and helped set up an insurance division there, but at the same time got agreement that I could get involved in all the other aspects of Credit Suisse related business, which included through an IT subsidiary there called CityMax, formed by the old Buckmaster and Moore, which became Credit Suisse Asset Management, and formed by Hoskins, which became Capgemini, which is quite pivotal in my career. We formed Arrow as being the leading product adopted by firms looking to interface to Crest when in 1996 Crest was launched into the market. And so I had a continuation there of the type of work that I was doing with FMIs based around technology. And it was my job in February 1996 when Cazenove changed supplier to be the person to get them live and steer it through to get them live for Crest in July 1996. Bit of seat of the pants because the publicity wasn't good in terms of the chances of Cazenove making it. And if you know the brand and reputation of the firm, they never miss anything, but also they don't quote in public. So there's a lot of stick coming my way, but at the same time, we delivered it on time and we achieved all the things that were expected. From my time at Credit Suisse, I also in CityMax, I also got involved very closely with the London Metal Exchange, with the old firms such as Rudolph Wolf, the old form of Rudolph Wolf, not the reincarnation. Got involved with Sodgen and Metals and people like that around innovative technology that we could move forward. And then when Credit Suisse and UBS failed to merge, I left and I joined a company called Capgemini. Very cyclical point for me because Capgemini, 6 months before anything was changed at CityMax, Capgemini had made the change already because the management came from the same stock and the same stable. So everything was tried at Capgemini, CityMax tried immediately afterwards. So my career went on very quickly there. I'll tie this up briefly for you. I helped set up and led the trading, clearing and settlement practice there at Capgemini, which over time became Capgemini Ernst & Young. Signed a technology partnership with Life, which was leveraging the ideas of Sir Brian Williamson to deliver technology to all the major exchange groups in the world. Got very heavily involved with LCH, and then I went over to Paris to run LCH ClearNet's technology across continental Europe in the joint venture that Euronext, who at the time owned 41.5% of them, in the joint venture that Euronext had with Atos Origin. So I was in Paris, had 100 Parisians on my payroll. Many of them actually worked for me. And we cleared 1.7 trillion euros a day. And then signed, which in today's mind is still quite incredible, a 10-year service contract with a 30-fold volume increase committed. And that contract lasted its entire 10 years, during which time I'd moved back to the UK, joined Euroclear, helped run Crest for several years before being asked to go to Brussels for 3.5 years to help transform Euroclear SANV, and also to help set up Euroclear Bank in Krakow. At that point, time to come back to UK, and I joined Ernst & Young, which had been the consulting arm of which had been acquired by Capgemini while I was there. So I ended up working with the same people for the last 7.5 years until launching Cornswood Group as an emerging exchange and market infrastructure advisory firm at the beginning of this year.
So tell us a little bit about Cornswood Group. What are the plans that you've got lined up there?
Very exciting plans at the moment. You'd have thought that at the time of COVID, it was the wrong time to get involved in setting up a new business. But funnily enough, the arrangements that we've already got in place are focused around cybersecurity and operational resilience, governance, and overriding all of that is strategy. So the strategy is where people are in the market, having had the history of working with so many different and innovative, and also those who are more dull and let's say bureaucratic exchange groups, but most are innovative across the years. It's being able to replay those ideas, look at how they can expand and give the stability and guidance of what is industry best practice, so that the strategy is set. Then you look at what's good governance, and underneath that, very much looking at the resilience of the businesses, because cybersecurity, and now that we've seen the changing world of people having to work from home in infrastructures that are not the most ideal, we've still got to be able to run highly resilient businesses. And we've now got a plethora of consultation papers out there in the market, 6 from the Bank of England PRA and FCA, 1 from IOSCO on outsourcing and third parties, 1 from ESMA, which is outsourcing to cloud service providers. And there was even one that came out earlier this week, and it's just completely slipped my mind which one it was. But so many different things going on at the moment. It's a fascinating time to have an understanding of how markets work and to help with the restructuring that's going to go on. And that's before we even talk about crypto assets and digital assets.
So the world as it sits in the world of exchanges, how do you actually view the health of the parish of market structure?
I think if we look at the way the parish has handled COVID-19, it has been extraordinarily good, because we view it on the outcome. And there's no question, the parish has evidenced that it's got a large amount of things that it does right. Some of the challenges are that to achieve that very positive outcome, there have been some compromises. There's been compromises by the regulators. There's had to be compromises in the way that people work, the environment they work, and we've now got to start and look at how do we make the adaptable way of working sustainable for the future. So at the moment, the parish is looking in good shape. We've got some further challenges. Paul Tucker gave rise to it recently in his paper. Some of the challenges are that the success of the exchange groups, and we can talk about which segments, whether it be trading, whether it be the clearing or the settlement or the market data. I noted Peter Randall's comment last week about from a Bats Chi-X point of view, he wasn't looking to get into market data at the time, but if you look at the profit margins there at the moment, it's high. But if you look at it, there's a concentration which continues. Look at the long end of the yield curve, the short end of the yield curve, whether you're in Europe, Asia Pac or US, they are dominated by a few key players, both at the trading level and at the clearing, and to a different perspective, also the settlement side. You only need to look at what happened with Brent crude and WTI to see that those concentrations need to be properly understood, not only by the professional wholesale market, but by the retail market, which off the back of ETFs and so on starts to get closely involved and then doesn't have the necessary skill set to understand what happens in the event of a particular contract going negative price.
Well, that's very interesting, talking about Brent crude and WTI. But I mean, wasn't a large amount of the problem with the West Texas Intermediate issue that, I mean, essentially the CME had this fabulous contract that they hadn't changed since 1983 when it was launched, when Dallas was one of the most popular TV shows. And effectively, the world had moved on incredibly. In Cushing, Oklahoma, which was one tiny little town with a McDonald's and a KFC and not a lot else, 5,000 or 6,000 people living there, really wasn't relevant in the world of distributing crude. And surely, therefore, that was fundamentally a problem with the exchange itself, wasn't it?
I think we've got to look at the impact of all the contracts and how they're treated and how people are using them, and this is where resilience is changing. Yes, from a single perspective, you could say, CME, you should have looked better at that contract and you should have made some changes about it. But on the other hand, you've got to turn around and say that contract, by not having changed, should be extremely well known and understood, and the pitfalls within it. And there are strengths and weaknesses in all contracts. I mean, that being a land-based one, that being based on a single location, you'd have thought actually the biggest strain would have come actually in the supply chain to get it there. But actually, it then became, if you look at the available capacity, it's already been sold, and there's more that needs to be placed there. But Patrick, I put back and say, you could use that one example. But what about LIBOR? What about the fact that people use LIBOR as the benchmark for products for which it was not designed? And then you can look at other examples. So I think Brent crude and WTI is a very good wake-up call to the ecosystems. Do you understand what you're involved in? I think in the vast majority people do, but there are nuances that are there. We're past the days when, funnily enough, someone didn't close out a physical contract and actually had the coffee or the cocoa or anything else delivered physically, or be told the ship's now sitting here with your commodities. We're past those days in almost all instances, but we're now into one of saying, to what degree do you truly understand the underlying? And that to me is where operational resilience comes in, and the duty that I see is evolving in the regulations is more one, not just of the fact that you've got substantial growth in your product set, but actually, does the community that use it truly understand the purpose for which it's being used? So in one way, you've got to answer to the central bank or your regulator, is the business case viable? You've got the other side, which is, are my consumers using it for the purpose for which it is fit and appropriate?
Okay, so let's leave West Texas Intermediate's Cushing crisis to one side and move on. Are you saying that exchanges and financial market infrastructures need to be more responsible about how they license products for other purposes? Or, I mean, in the case of LIBOR, it wasn't really a case of licensing per se. I mean, how can you expect, or do you expect the financial market infrastructures to be responsible for ultimately every possible type of end user? Because that's surely impossible to please.
It's unquestionably, it's not the responsibility of a financial exchange to produce a product and then ultimately police every instance in the way it's used. If you look at it, let's take an example. The Royal Mint produces coins and notes, but once it's produced it has no knowledge whether it's used for legitimate or illegitimate purposes. In the same way, you could argue that if I produce a particular product and I very clearly signpost it, then actually, if somebody chooses to use it, and I've got no control necessarily over the way in which they choose to use it, am I accountable for it? No, I'm not. But what I am saying is that if you look at how the regulations are evolving, there's a greater emphasis now on customer harm and the degree to which you have an understanding of the ecosystems in which you work, and also that the participants in and the other participants in the ecosystem, how you're going to react either in a stressed environment or a rapid growth environment, and so on. Let me take the example of the recent outage of Visa. If I remember correctly, if you go through the minutiae of the report around that, one of the key areas that Visa during the outage were criticized, and it was this puts a new lens on where regulations and ultimately where the legislation will be focused, was around communication. They came with a statement that actually Visa were criticized for not communicating to their customers the reminder that they could also use MasterCard. Now, that whole concept shifts the mindset. It means that profit is good, growth is good, and let's face it, employing people at the moment is a very good thing to have done. But it's also that there's an element, and it's going to be very difficult to identify how you judge it, because it is a judgment, but an element that says, how are you being responsible in what you're doing? I really am impressed with the work that the London Metal Exchange have been doing around responsible sourcing of base metals, because that is a really tough one to try and cover in a wholesale market. That is incredibly difficult. But those same lessons, and we saw with the OECD responsible sourcing and LBMA with the responsible sourcing of gold and so on, those lessons are there and they're going to become more and more prevalent. So the wisdom is not that exchanges get held singly accountable to the use of their product, but increasingly, I anticipate that you're going to be required to be more accountable for the level of responsibility you've shown to how it's being used. In the same way as whichever lager or beer or wine you pick up, there's an element of reminding us there, please drink responsibly. Even the betting firms are doing it with please bet responsibly. So I would never say that it's the exchange's responsibility for sorting out how somebody deliberately uses their product, but you've got to have a degree of communication to say, we think this is overheating. And you could even use Northern Rock as an example. The growth of that business was such that you need to question, was the business case sustainable at 125% mortgages, and how is that good? And that's where there's a change in mindset. It doesn't mean it was a bad thing to do at the time, because that's what everybody did. It's actually, we're in a different place now. Does that make sense, Patrick?
It does make sense, but I mean, I would have thought that the Northern Rock thing is surely something where clearly, because they were in possession of the data, the central bank should have been most concerned about what was going on in those particular. And I'm not trying to specifically have a go at the Bank of England here looking back, but on those points, obviously the amount of regulatory data interface is going to be key. And this actually raises something that I find quite worrying, which is a huge number of regulators have demanded ever more data from exchanges over the course of the last number of years, but there's precious little evidence of the fact that they're actually able and have the budget to process it.
Yeah, I think we're on a journey here. I'm not going to defend the fact that there's a vast amount of data going into the regulators, and I don't think that they're wrong in asking for it. I think they're right in asking for it, but I think the latitude in how it's received, how people get used to sending it, how the information becomes more consistent is important. But the part of the journey is that we're currently in the phase whereby you can look back at the data and see if there's been misconduct. You can look back and see if there were other things that were wrong. Our usual thought is, if I'm sending you the data now, you must instantaneously, as the regulator, have analysed that data and know the answers. Well, we're currently in the guise whereby, and don't forget, you and I, through our pensions and everything else, are having to pay for this regulation, that the information is available not only for today's view, but also a look back to see were there dynamics that could happen. If you took we mentioned briefly LIBOR, if you took the LIBOR curves of a vast number of data, only when you put all those together were you able to then start to piece together and say, we can see some outliers, and we need answers to why there's unique outliers which don't make sense. Now, we're in that part of the journey. The question is, are we as members of the wholesale financial market, are we as members of the retail financial market, and are we as members of the population willing to pay to have that data more asynchronously validated, tested, checked at the point that it's delivered? Or are we actually looking for a hybrid? I think the market's out there that technology will be able to give that level of view, but it's going to be inordinately expensive. So I think it's a good step forward to have a greater level of reporting. I'm still personally, and this is a personal view, unconvinced about the electronic tape discussion. But in terms of getting the data out there and getting transparency and the ability to look back, I think that's a positive step forward. I think the question is how much more we invest to be able to have simultaneous, I got the word in the end, simultaneous regulation on live trades as they're happening. It's an interesting dilemma.
And of course, something which might be cured by quantum computing?
Absolutely possible. But now you've got to get that combination of the upcoming brilliance of technologists together with the wisdom of people who actually understand what's going on inside the black box. If you look at the dynamic we've got, how many people truly can tell you an end-to-end process of a financial transaction? I remember when I went over to Paris and I was clearing 1.7 trillion a day, or to be more honest, 100 people on my payroll were clearing 1.7 trillion a day. And I asked, who's my global architect? Because I want them to talk me through end to end how this all works. And I was told there were 30 of them. And each one looked after their own piece, and each one looked after their own bonus. So I wasn't able to get that entire view. We could piece it together eventually. But when it came to put in, for example, propositions for intraday margin calls and so on, I'm suddenly finding I'm changing 5, 6, 7 systems. So who's got that end-to-end view? That's a hell of a challenge. And if you're going to actually say that quantum computing can achieve the level of data processing, absolutely it's got the potential. But we've got to invest significantly to be able to have those perspectives. And I think this is where it plays into the concentration that we're seeing going on amongst exchange groups, that we will get more and more expertise and concentration of financial markets in a smaller number of players.
A smaller number of players, but aren't we also seeing a problem with that because of pure monopoly and antitrust constraints around the world?
I think you are to a degree, but then let's look at how many CSDs there are in Europe. My recollection is there's 39 in, that's more than one per country, and the US has 1. It's not economic to have 39 FM. This is CSDs, central securities depositories. It's not economic to have 39 of them. What is the right number? I don't know. 2, 3. At least you've got some competition, but you don't need many more than that. CCP is a different dynamic. How many CCPs do you need? Well, it's relative to the sort of product sets that they've got. Now you've got the challenge that the CCPs themselves have got the concentration of different products in different CCPs. If you then come to the trading platforms, the exchanges, well, we've got an increasing complexity of the number of trading venues that are out there, whether they be CEFs, whether they be MTS, whether they be OTFs, whether they be the recognized market with the recognized investment exchanges. There's a plethora of them out there, and it's only growing. Crypto asset exchanges as well. What we're looking at here is the ability to be able to trade what you want, where you want, and how you want. And then the focus needs to be, from that perspective, on those being eligible, high grade or extremely well understood products. Then where do you go with the post trade? And the post trade is going to be the area where the concentration needs to come at the settlement finality area. And it will come. We saw this with the airlines. If you looked across, every nation felt they had to have a national flag carrier. And all of a sudden, Sabina's gone, Swiss Air's gone, and so on. And it was not because people didn't want to have a national flag carrier as their airline. It's because it wasn't economic. And we've got to look at this from an infrastructure point of view. And I know that you'll always have people talking around what can be achieved with distributed ledger technology, with artificial intelligence, with machine learning, and so on. The world is dynamically changing. And some of those will start to offer a level of comfort that they can then help consolidate the market even further than it has now. There's a lot more still to be done, and good business for corporate financiers.
And advisory groups such as Conduit Group, I presume.
Very happy to help. And there's no question, Patrick, there's no question. The level of change that is going to go on, it's a very positive thing. And that includes the innovation of new firms.
Right. So the innovation of new firms, you're talking about the whole issue of resilience and so on. And by the way, ladies and gentlemen, by all means, send us a question. If you've got one coming in, we'll be more than happy to deal with any of your questions, queries, or comments that you may have about this evening's show. You mentioned several times this whole burgeoning new area of cryptocurrency and crypto assets. Talk us through that for a moment as to where you see that fitting in.
Yep, certainly. Let's look at what's happened with payments. If you go back 10 years ago, I would always have walked around with notes in my wallet. I would have notes in favor of using my debit card and in favor of using my credit card. Mm-hmm. Roll forward to now, and in fact, just look at the change from 14 months ago to 2 months ago, when we had the real impact of COVID coming through. Financial transactions which were paid contactless were more than doubling in terms of the percentage of financial transactions that were going on. If you look at the number of transactions that are going through the RTGS system, it's 98% is wholesale and only 2% retail. And yet the retail market is moving almost exclusively across to digital payments. And we've already got the fact that you're not walking around as a bank saying, I've got to go and pay 3 billion across to JP Morgan. Here, I'll go and take it either as bearer bonds or I'll take it as cash. It's all electronic. So we're in a world where actually so many of us are born analog, living digital. And we're seeing, I can't remember the last time that I went to an ATM machine and got notes out. It isn't the way that people are so comfortable living these days, but there's still a purpose for it and it's got a role. So what are we going to do? Well, there's been a lot of effort by firms and technology firms alike, looking at how they can create stable coins. Stable coins aren't your crypto currency like a Bitcoin. A stable coin actually is reserved against a fiat. Or a basket of fiat, so it's got an established redeemable value on top of a stable coin, which can help us with the purpose of using, in effect, commercial bank money. In this case, it may be a technology bank money. You've got the other aspect, which is the central bank digital coin. Now, I'm only for the moment sticking with payments. There's a lot more to look at other assets as well. But if you start looking at that, we are in a world whereby we'd like to be able, and so many more people these days are actually going out and saying, I've got a single card with me, that's all I need. I swipe it over something and everything's done for me. We're now looking at how does that work in a much more prolonged basis? How do you actually get the benefit of central bank currency, central bank money, and the higher grade credit rating that has? How do you get that down to the lowest common denominator, potentially even being the retail man the retailer in the street and the person who goes in to buy a loaf of bread? Those are some of the dynamics that are changing. We're seeing crypto asset or digital asset exchanges being set up. You only need to see what's being achieved at a range of different organizations. Archax, the Xberry last week announced that they'd signed up LDX. That there are more established and a more well-rounded crypto asset exchanges coming in at a time when we're looking at both the payment side and we're looking at the asset side in a new digital environment. It's going to take time to actually evolve. These things are not going to be transformed overnight. I mean, I remember a while back when Settle came into some offices where I was there, and they showed processing of 1 billion transactions in a day across a blockchain. So there are capabilities out there, but this needs to be very carefully and very slowly and methodically put in place, not too slow, please, with the right regulations, the right legal structure behind it, the right acceptance from the ecosystems. That's not only the participants, but all the way through to the central banks, because we are evolving into a new world. The central banks themselves have published a number of papers on central bank digital currencies or reserve bank digital currencies, and I would look at those very carefully. I'd still be reasonably astute to the point that they're not in a rush to get there, but they do recognize that this is an evolving world that we're in. So a little bit of a meandering there, Patrick, and I'm very happy to pick up on any of those points, but I didn't want to deep dive in one of them specifically for the nature of the call, but we can do it any time you want.
Fascinating altogether. And actually, we have a question. So that's what I was just looking at just a moment ago. It's very intriguing altogether, Martin, because we've got a viewer is asking, they've come anonymously via LinkedIn by the looks of it, what therefore are the advantages, the benefits to digital assets, given the fact that anyway, when you trade a share, when you trade a bond, they all tend to be dematerialized these days?
They are dematerialized, but how long does it take you to actually get your shares? If you decided that you actually wanted to go and buy some Vodafone shares and so on, how long does it take you to actually get that transaction through? When you move forward to look at what can be achieved in the digital assets, and it's highly likely that you'll see the more traditional markets under a lot of pressure. Taking Jeff Sprecher's comment, the world is becoming much more electronified. How long before you're going to get the bulk of the financial products that we're involved in, whether they are bonds, whether they are shares, whether we're talking about digital assets, whether we're talking about a digital currency, whether it's a central bank currency, getting those to a point whereby they are so commoditized that actually they are available instantaneously. It's a T-instant transaction. You're not seeing that you've got to go through a long routine of getting all the paperwork, getting everything checked. Reconciliation should be done before the transaction. The reconciliation comes from the fact that you know specifically that currency, that stable coin or that digital central bank digital coin that exists, it's ready, and instantaneously it can be yours. Listening to the question, and I'll just play it back to you, Patrick, in case there's an element of it that I've missed. Listening to the question was, well, if we've already got dematerialization, what's the benefit? Well, the benefit is dematerialization doesn't give you everything you want. Dematerialization means it's not held in physical form, it's held in an electronic form. Funnily enough, you actually miss one of the things by dematerializing it, which you can get off physical, is when you put them into the warehouse over in Luxembourg of Clearstream or with Euroclear Bank, you can actually look and go, that's a slightly different shade of pink. And you can pick up fraud, funnily enough. But now in dematerialized mode, you haven't got that challenge. What you've actually got, one, is how can I speed up the process of getting it? So I put that as a combination. It's a hybrid answer, because if you've got dematerialized stock, the question is, how long is it taking you to actually complete a transaction? If it's T+2, well, what are you going to do about the risk? You've got to use a CCP.
But then again, looking at it another way, I hear what you're saying, but looking at it another way, the Moscow exchange and also the Kazakhstan stock exchange both managed to do T+0 settlement. So they managed to do settlement within 1 day. Their problem was actually that when they then wanted to offer their securities to a wider market, basically Western Europe, where all the money is, and one might argue some of the technology savvy, they suddenly had to go backwards to T+2 because actually the Euroclear, the Clearstream, and not just Euroclear and Clearstream, the whole mechanism couldn't function around that.
Yeah, you're absolutely right. And as you may recall, I was on the steering committee for AIX in Astana with the in Kazakhstan. The challenge you've got, and I picked something up that Alan Lyon of Foreign and Colonial told me, and he told me this, goodness me, we're talking back in about 1996. He told me that we can do T+0 now. What we can't do is we can't do it to the extent that we want to. We can only do it for particular types of products. He said the chances of being able to do a T+0 trade with a Mexican, when I've now got the FX and it's not in dematerialized mode, but if it was in dematerialized mode, I've now got to go through all the different routines of both sides to get that transaction through. Nothing wrong with Mexico. The challenge they've got is it's going to take them days. So you couldn't do a T+0. So what you're now looking at is how can we get everyone to the same playing field, that there is acceptance you can do. And don't forget, T0 could be anything up to 23 hours, 55 minutes or 59 minutes. T instant is you do it now, or you specify the point in time at which you do choose to do it. And that's got a huge technology transformation that needs to be got through. If I want to do a transaction with you, Patrick, and we do it T0, I'd still like perhaps to say, let's do it at 1852 British summertime, and then we're done. So my thought on that is, yes, you can pick on some of the smaller markets and you can show that T0 is possible. I can show you examples where people have been doing T0 for a very long time, but you can't get all of the products. Because don't forget, for the more complex ones, this is a much greater level of complexity that you're having to deal with. But also, even for the more simplistic domestic ones, you should be able to get to the point whereby you could consistently do them T0, T1, or T2, depending on what the implications are of the different systems, the different players you've got, and also, let's face it, where the bulk of the market is, where the liquidity is. Because if the liquidity is not at T+0, I'd actually be rather on a slightly longer market if that's where liquidity is. So you've got to gradually move these things up.
So if you've got to gradually move these things up, does that mean, therefore, you see the token asset architecture as being potentially the architecture that may be adopted by the legacy exchanges in due course, or do you see that as a new thing which will spur out its own kind of business in its own way?
I think you're going to get both, because I think the first thing is that this is the testing ground of a new innovative way of trading platforms evolving, and it's being done with an evolving asset class. So for which the regulations are not necessarily in place, nor is the legislation. So whilst some of it is in place, which is great, and whilst some of the regulators have already adopted it, you can get certainty over certain aspects. So you're going to see certain exchanges, you're going to see certain market infrastructure players, either new ones or some of the established, sampling, testing, trying, and moving it forward. It's not the Wild West. This is much more, because that's where your cryptocurrency Bitcoin element was having such wide variations. It wasn't suitable for anyone who was looking for a stable market. It had other reasons it appealed. But what we're looking at here is that there's going to be a number of innovative ventures from people who come from wholesale financial markets, who are developing digital asset exchanges, and then over time you'll see that will then flow into digital asset market infrastructure, and some of that will be sponsored, supported, helped by financial exchange groups, and the rest will be new initiatives coming up, maybe VC funded, maybe part funded by some of the more innovative fintech investors. But also the exchange groups are going to be very carefully watching, and exchange groups, I also mean all the FMIs, CCPs, CSDs, market data providers. They're all going to be very carefully watching as it evolves. You only have to look at what happened with ATSs and ECNs in the late 90s in the US, that they started eating away at people's market share, the market share of Big Board and also of NYSE and also of NASDAQ. And then eventually over time, they start getting acquired. And if they're not acquired by the exchange group, someone like Spearlead's Kellogg was acquired quite a high price, but by Goldman Sachs. That's to get hold of the technology. We saw the same happen with MTFs over here, whether it be Turquoise with Eli Liederman, whether it be Chi-X into BATS and then SIBO. A whole range about Equiduct has had several different ownerships. Now, all of those have actually been more or less with the same asset classes that they've been looking at. The difference here is that we're going to have new asset classes. I mean, I worked with the Royal Mint on looking at how you could create a blockchain service for gold with that was a digital gold representation, which was Royal Mint gold, and underlying that was physical gold itself. And that was in a relationship that the Royal Mint had with the CME. Very positive stuff moving forward, and it was testing out the model. And you see that elsewhere as well, Patrick, where you've got the exchange groups working with other participants from slightly different markets, where they be commodities markets, in this case it was the Royal Mint, to look at how they could leverage technology. Euroclear and Paxos were working together to look at what they could do. This is public domain with gold, with a gold blockchain. And the purpose there was, again, to try and see if they could do it. But look at those. Those are different asset classes, and seeing how it could be the trial ground and the testing ground for the more traditional marketplace. And I think you'll see the same happening with digital assets. And some of those digital assets will become hardcore, mainstay, benchmark products of the future.
Martin Watkins, thank you very much for a fascinating hour. It's been wonderful to chat to you this evening. You've come to us from the home of Dilly Knox, the language expert who linguistically was putting together a great deal of computational genius that helped, well, in so many ways with what was an enigmatic Enigma project during the course of the Second World War, also powered by Alan Turing, who was, of course, the mathematical side of the equation. I think you've eloquently brought together the words and the tricky sums of financial markets and how we're looking at them in their financial market structure, and the overall question of resilience as we move forward into what is potentially a quantum computing environment. And it's fascinating to see how you've been talking about, well, all manner of issues in terms of how resilience itself is changing, the changing economics of the settlement of financial markets, the changing economics of the CCPs. We touched upon briefly, I'm sorry we didn't get a chance to talk about it more, the Sir Paul Tucker report of the other week and what was going on. You also mentioned this whole concept of, what you want to do is basically you want to be able to trade anywhere, anytime, anywhere, any place. Martini markets, as I like to call them. You are indeed a fellow follower of the bold practice of life, born analog, living digital. And it's fascinating, as you say, how the complexity of what digital assets are trying to do lead to some fascinating new issues, of course, because indeed T+0 can mean potentially 86,400 seconds in a day. And that only leaves me to say two things, really. Thank you very much, Martin. We are going to return next week in a little over 600,000 seconds. In fact, we're going to be welcoming the head of NASDAQ in Europe, Bjorn Schuborn. He's going to be coming to us from the wonders of Scandinavia. I wonder if it'll be as warm as our production team are enduring in northern Poland today. And whether or not it's new asset classes, however you look at them, one thing we've been looking at for many years in financial markets, ladies and gentlemen, is technical analysis. Technical analysis, of course, being the practice of trying to use alternative means of crunching data, price charts et al., in order to come up with some form of analysis of the marketplace. Well, during the course of the last week, we've seen a whole new technical analytical sign. A sign in two senses, in fact, because during the course of several days of incredibly heavy monsoon rains last week in the Indian financial hub of Mumbai, heavy rain toppled the actual sign that sits above the Bombay Stock Exchange building. Now, ladies and gentlemen, at the point where the signage itself has been knocked off the building due to heavy rain, one has to consult, I suppose, Rune Readers Anonymous to see how they might interpret this. Is it an auspicious sign? Is it a good sign for markets? It's certainly a technical indicator, I believe, to be without precedent. My name is Patrick L. Young. We'll be back in just over 600,000 seconds with IPO issue number 5. Thank you very much to our guest today, Martin Watkins. It's been a joy to hear about him and the Currensword Group from his incredible country home in Buckinghamshire, just outside the city of London, but nonetheless within its technological ambit. My name is Patrick L. Young. Have a great week in life and markets. Thanks to our production team in Poland, Bata Trachikowska, and also Ola. It's been a fascinating discussion. Enjoy your week, ladies and gentlemen. This is IPO Live number 4, signing off.